Social media interactions become interesting only when it is two-way. You must get a fair chance to interact with the person you follow or the person whose videos you watch. I have started this new initiative, Ask Milestones to Wealth Anything, AMA in short, through which all of you can stay in touch, ask me questions you like to ask, clear your doubts on personal finance, learn more about Milestones to Wealth and about our PMS products, and stay connected. So, this brings us closer. I am able to be closer to you, to help you in whatever way I can. You feel closer by asking whatever you wish to, and we grow together, helping each other along the way. So fill in this form and stay connected through Ask Milestones to Wealth Anything. Mutual funds versus PMS, which is more tax efficient? If you have a lot of money and you want to invest in the equity market and you want your money to be managed externally and not by yourself, then you have a choice of investing in a mutual fund or in a portfolio management scheme. A mutual fund clearly offers superior tax efficiency because short-term capital gain as well as long-term capital gain in a mutual fund is exempt from taxes. Dividend income is also not taxed. On the contrary, your income in a PMS is definitely taxed at a higher rate, and you have to pay taxes on short-term capital gain, long-term capital gain and dividend. So, if you are invested in a product which involves a lot of churn and trading, then the mutual fund ecosystem is naturally superior. But if you are invested in a product which is a classic buy and hold and does not do trading and never generate short-term capital gain, then you are likely to have taxation impact only on the dividends and not on the short-term capital gain. And if you don't churn much, even the long-term capital gain could be modest. So it's important for you to invest in a PMS product only if the manager follows a very disciplined buy and hold long-term investment approach. On the contrary, if the manager's philosophy is to keep trading a lot in a portfolio and increase the churn in the portfolio, then your taxation in a PMS is bound to be higher. So when you look at a PMS or a mutual fund, you have to see what is the philosophy of the product, what is the process followed by the manager, how much churn is there in the product, and satisfy yourself that it is a low churn product. In a mutual fund also, while they don't pay taxes on the capital gain, a high churn product inflicts a natural risk on the investor because the number of decisions the manager makes will be very high. He has to be seamlessly able to exit certain stocks and enter newer stocks with a very low impact cost, which is a very tall order and a very steep ask because impact cost is so high when you buy and sell a lot in a mutual fund. And often this impact cost can inflict an unseen damage on your return potential. If I am going to follow a passive approach in a portfolio and not do much churn, then there would hardly be any impact cost in my portfolio. So on the one hand, if you have a PMS which follows a classic buy and hold with a very low churn, the tax in that portfolio would be low. But on the contrary, if you had a mutual fund product which has a very high churn, while there is no tax from capital gain, you would be suffering high costs due to significantly elevated impact cost. And these are things that never get calculated because you don't know what the cost is. Nobody tells you that there was so much impact cost related to high churn. It's not a data point that anyone releases. So I think you have to look at each product clearly, look at the philosophy of the product, look at the philosophy of the manager, look at the style of investment management, and then decide which is more efficient for you. There is a possibility that despite having to pay both short and long-term capital gain and tax on dividend, a PMS turns out to be more efficient than a mutual fund simply because the manager follows strict discipline, low churn, and significantly extended holding cycles. If you have such a manager, then a PMS is good enough. On the contrary, if you find a manager, even in a mutual fund, who follows the same philosophy, then that would be an extremely superior product because it doesn't have to pay taxes on dividend, on short-term capital gain and long-term capital gain. So that in essence is how you have to see this comparison and decide whether you want to invest in a mutual fund or in a PMS to take greater exposure to equity. Thank you for watching this video.